Hi, everyone. I'm Rick Bensignor. Today is Tuesday, August 16th, and welcome to this week's In the Know Trader Show. Let's take a look what we have on tap for us. In our trader education portion, we're really going to focus on trading like an institution. And what I mean by that is you want, as an individual investor, to buy at wholesale prices and to sell at retail prices. That's the way institutions trade. We'll talk about that. Today in our focus, we're going to look into an ETF, and we're going to look at Cathy Woods ARKK Fund, the ARKK ticker symbol. So we'll take a look at the chart of the ARKK Fund performance. We'll look at it versus the S&P, and then we'll dig into the top 10 holdings of the ARKK Fund, and we'll look at each individual chart to see what they're showing. As a reminder, or if you're a first-time viewer, if you're interested in my weekly ETF Tactical Trader Report, go to inthenowtrader.com. This comes out every Thursday. In it, we look at the whole macro picture of the market. So we look at what's going on very specifically in the bond market, in credit markets, in a deep dive into the S&P. We look at many weeks, the dollar, gold, oil, and the energy sector. So you get a very good backdrop of what's driving the markets each week, as well as how to play each of those markets. And then I'll pick a new ETF trading idea for you each week. And we generally will hold those anywhere from many weeks to many months. So it's not, generally, it's not short-term trading in and out in a very, days or a week or two later. Generally, we have a bigger holding period than that, but it is not intended to be medium term either. So we kind of call it somewhere in the short-term range of weeks to months. And then we review every open trade we have in that Tactical Trader Report portfolio, we'll call it, every open trade until we close it out. So you're not left hanging with some idea that I put out 2 months ago and you don't know what to do. Every week, I update the charts on all those open positions, how we're playing them, if we're scaling out of a position, where those are, moving stops, etc. That's our weekly Tactical Trader Report. We also have a monthly report that we call the 7-Eleven report. And that is a report for individual investors as well as financial advisors who have money in the SPDR ETF. So a passive index that represents the S&P 500. And instead of simply being in that, we have devised a way to do what most on the street cannot do, which is outperform the market. So we have consistently outperformed the market. This year alone, we've outperformed 6 out of the 7 months of this year. And through July 31st, the last time we've compiled our monthly statistics, we're outperforming the S&P by 2.6% this year. This same model, and since we started this 7-Eleven report back in August of 2020, so it's 24 months now, we have outperformed the S&P by 7.16%. That is a huge amount of outperformance in the money management industry. As I said, very few outperform at all. We have outperformed in the up market. We have outperformed in 2022, which has been the down market. We have continuously outperformed. So if you have money in SPDRs, this is a report that's sub $100 a month. It's $87 or less, depending upon how you sign up and the term. It's $87 or less a month. And what you get is the chance to allocate based upon my allocations across no more than 7 of the 11 macro SPDR ETFs, like XLK, XLI, XLF for financials, XLE for energy. There are 11 sectors to the market. We consistently figure out where we're going to get underperformance, and we try to stay out of those sectors that are going to underperform on any given month. And we have continuously successfully done this such that we are outperforming by over 7% in 2 years. That would put us in the top decile of all active money managers benchmarked to the S&P that exist out there. So I highly recommend, if you have money put into passive indexes, that you consider subscribing to the 7-Eleven report. For either of these publications, you can go to inthenotrader.com, sign up for them. You get a 7-day free trial to check them out, and we will not charge your credit card until 7 days pass. So this is a free look into trading and investing along and in the style that institutions do, and a way of, in the case of the 7-Eleven report, outperforming the market based upon a 2-year track record now of using both a combination of technical and timing inputs that we use, as well as a very sophisticated quant model. And we take the compilation of those rankings of each one of the 11 sectors to determine which ones you want to be in. And that you can get that from inthenotrader.com. Of course, I've recently started my own In the No Trader YouTube channel. I am no longer doing any videos for stockcharts.com. I'm doing everything through my own channel. So please go to YouTube, follow the In the No Trader channel. Here is a shortened link that you can go to, and I point out that this last figure here, this is a 0, not the letter O. Go to this, or just go to YouTube and go for In the No Trader. Follow the channel, and every time I put out a new video, which this one is, you will get an email saying that there's a new video available. I'm going to try to stick to the same schedule I've done in the past, which is publishing these videos on Tuesdays. Lastly, my Twitter handle, if you want to call it that, is @InTheNoTrader. So I put up some information on Twitter too. So that's another way to follow me, but definitely you want to follow my new YouTube channel. Okay, let's go back and get into this idea of trading like an institution, meaning buying at wholesale prices, selling at retail. And we'll first talk about this, and then we'll kind of look at it on charts to show you pictorially what I mean. So how is it that institutions almost always outperform the individual trader? Well, some will say that they have inside information, but let's assume that their information is not what you would call inside. All right, they're not getting they're not getting insights into a company that the public now can't get because of fair disclosure regulations that came in, I don't know, 15 years ago or so, something like that. So, but there are reasons that institutions outperform certainly the individual investor. And I want you to be thinking along those lines, because as an individual investor, if you do what most people tell you, if you do what most books tell you, by the time you decide that a stock has moved up enough that it has bottomed and it's safe and moving away from the bottom, and you've gotten confirmation that the base is in place, or let's just say the bottom is in place, you're often at least 10% to 15% off the bottom before you have that type of confirmation that a low is in. And if you think of this in terms of when you sell something and you have enough confidence and confirmation that a top is in place and maybe this thing is going lower, maybe I should be getting out, again, you're usually 10 to 15% at least off the high, which means in kind of a best case scenario, you've got maybe 70% of what's left to take advantage of. And when you play just by chance, 70% is very close to 68%, which mathematically and statistically is the first standard deviation in any type of statistical analysis. So you're left with essentially what we call the fat part of the bell curve, the middle of the price movement. And for every time you're going to buy well and kind of buy somewhat nearer the low and sell somewhat nearer the high in that scenario, you're also likely to buy deep in an uptrend and eventually sell it lower towards what's really the bottom. And that stuff tends to wash itself out enough so that the average person can't outperform the market. And in fact, even the average professional money manager doesn't outperform the market because they're doing the same type of thing, waiting for confirmation, waiting for analysts to upgrade stocks, which usually don't come or downgrade stocks at highs and lows. They come well off the low and well off the high. The reason why the Goldman Sachs's and Morgan Stanleys of the world are so successful over time from their trading side, not talking about investment banking revenues or other parts of their businesses, but from pure the market perspective, is because they'll buy at wholesale prices. They're not waiting for the confirmation to buy after something's moved up and they feel it's safer to buy. They're generally sticking their necks out and buying when they feel like things are cheap enough price-wise or valuation-wise that this is a good time to get in. Even if they don't have the exact low, they're getting in at what we would call buying at wholesale prices. Then the rest of the crowd ultimately comes in and pushes a stock higher, and that's the retail crowd, the individual investor. They'll ultimately, they being the smarter money, the buyers at wholesale or the sellers at wholesale prices, are eventually getting out of their positions almost always to individual investors collectively. So what are also known as retail traders, not to be confused here with the term buy at wholesale, sell at retail, but it's almost like buy at wholesale and sell to retail investors. So when they think something's worth buying, they buy it and they're not waiting for all the confirmation. And then when it's moved up well higher and the public is strongly talking about how good a stock it is and everybody's jumped on board, they'll eventually get out into still late to the game, generally individual investors who are buying. And that's how they exit. So the reason why these companies can be as successful as they are, as well as some smart hedge funds, is they're in theory thinking like this: buy low, sell high. And that's what we're all supposed to be doing, but so few people actually do this. They buy kind of medium in the price range and they kind of sell medium in the price range. So sometimes you make and sometimes you lose. And even if you make money at the end of the year, how often are you actually making more than the passive index and the S&P or the NASDAQ 100 or whatever area of the market your particular names are in? It's very infrequent that the average investor outperforms the passive index. So the whole methodology that I've spoken to you about is come from over 30 years of trading and being on the sell side. I'm on the street now over 40 years. And the first 12 years of my career, I traded in the commodity pits, where I really learned about trading in a way that not even upstairs traders can understand. There is nothing better than being a floor trader to understanding the mechanics and the psychology of successful trading. So I had that as my start before I ultimately ended up on the sell side. I spent 10 years at Morgan Stanley and 3 years at Bloomberg, designing their whole charting system and being the head of commodities, futures, and technical analysis at Bloomberg. I worked at Wells Fargo for several years and other firms where I've taken all the skills that continuously built over time in order to be able to help my clients, the clients being the clients of the firm, who read my research, to be better traders, to be buying at wholesale and selling at retail. So let's take a look at, let me pull up a chart here. And this will actually end up being close to, we're going to look at, we'll actually focus in on the second part of today's show, which is looking at Cathy Woods ARKK fund and what it's showing, as well as the component names to this very heavily invested into ETF, which the retail crowd owns a huge amount of. And unfortunately, most retail is underwater in this name. So this is a monthly chart of Cathy's ARKK funds. And in fact, let me even just take off the cloud chart for starters and just show you the concept of selling at wholesale from the models we use. And in this case, it's this blue 9, and buying at wholesale here and letting the rest in between kind of be handled by individual investors who will either, if we can get through here, 5274, which has been in place as our first important resistance level since the lows were made back in May. So this actually bottomed slightly before the June low for the rest of the S&P, but this is where I got clients in. We have an average long for in-the-know trader clients at 43. My institutions, I actually was able to get in at 40. And we're still holding it, and we're going to have to decide shortly if we think this is going to break through and move, up to potentially the upper 60s, 70-ish level or not. But here's when I add, let's say, the cloud chart to it. Probably at this point here in December of 21, retail is starting to sell, saying like, oh, there's real trouble here. And if you sold that well at 90 or above, you did great because the stock got down to the upper 30s. And there's plenty of retail who haven't sold anything and have stuck at much higher levels. As I said, I've been now getting in-the-know trader clients and institutions down at the bottom, which to me were wholesale prices that I was able to determine from a variety of models that I look at to get you back into this name. So here, in a very quick sense, is the concept of both selling wholesale on the top and buying wholesale on the bottom, and letting retail deal with all the kind of nonsense in between. That's the idea of buying low, selling high, or in this case, selling high, buying low. All right, so what's this chart say? Now that we'll get into the ARKK fund, notice now for 4 months in a row, the monthly range has basically been contained by the cloud itself. So right now, this still has not broken out to the upside. It's still in a bottoming pattern and starting to show some life, but I'm not convinced yet. So we're up anywhere from 15 to over 20%, even 25% for institutional traders or so. So we may take some off here and then play for another move up, and that's probably it. I'm not going to play for this to come all the way back up to where it is. Maybe over time in 10, 20 years or something it does. I'm not playing it for that. I'm playing for an intermediate move here. But this is the look of what the ARKK fund right now is looking like for a longer term chart. So I still do think that if we can get through the low 50s here, this has room to move. And I'll probably aim for something in the 60s to take profits, but we may even take a piece off very shortly if this can't go much higher. Let's also take a look at ARKK relative to the S&P. And once again, on the highs, we had signals for true exhaustion. Now, some showed up earlier, but those aren't the ones I happen to take. You can see relative to the S&P, we have signals here on the bottom. MACD kind of nicely lined up with that. It doesn't often, but this was a case that we're getting supporting evidence that there's still some base building here, but we potentially have a bottom in. And so when you look at it relative to the S&P too, you see that since May, it has outperformed the S&P. So you've actually been better in the ARKK fund. And pretty much where we got you in was very close to the bottom of relative performance too. So that's a look there. Now, let's take a look at the biggest names, the 10 biggest names in there. And we're going to start off with Tesla. Oh, actually, before we go into that, let me go back for a second to our PowerPoint presentation, because when we dig into ARKK, let me show you this next thing. This is the ARKK fund's holdings, both based upon the sectors that the top 10 names are in and the actual top 10 holdings by weight. So we know Tesla is the biggest weight, followed by Zoom. Combined, you have about 17%. And in fact, if we throw Roku in, you're almost at 25%. So a full quarter of the fund allocations are in these three names. So you really, if you like the idea of buying ARKK or whatever you're going to do in ARKK, whether you're a buyer or seller, you want to take a look at the top holdings and their charts, because that's how you're going to have a sense of what this is likely going to do. So when you've got 25% in three names and close to 30% in four names, you really kind of want to go through those names yourselves to take a look at what those charts say. If you want to buy ARKK, you want to make sure that the biggest holdings also have good-looking charts, or at least enough of them do, because these are the weightings that create the price, the underlying price and the net asset value of the ARKK fund. Also, when we take a look at the sectors that the top 10 holdings are in, we see that technology services is 43% and health technology is almost 26%, right? So we're getting close to almost 70% of the fund is in these two sectors. So you want to find, also do your analysis to make sure that technology services and health technology look healthy if you're looking to buy, or don't look healthy if you're looking to sell. So when you want to go into an ETF, you also want to take a look at what are the top holdings in the ETF, right? So if you think about communication services, that ETF, that's XLC, that's one of the 11 SPDR macro ETFs. If you take Google, the two Google A shares and B shares, and put in Meta, the former Facebook, you have a huge percent of that entire ETF is Google shares A and B and Meta. So you've got to look at those stocks if you're going to go into that ETF, because you could look at the ETF and just do your analysis on them, but you want to know where those top holdings are also, as far as, because they're such big weights. Is one right on support, but if it breaks, it's going to change the whole game? You want to know that. And it doesn't mean you would stop buying the ETF, but you'd want to know and pay attention to, hey, if, Meta was coming out with earnings, let's say, and they miss, that's going to change the whole picture of this, not only because it's such a big weighting, but the stock itself could get pummeled and really affect how the ETF trades. So you want to look, when you're looking into ETFs, you want to look at what their top holding are. Here are the 10 biggest names, as well as how they're represented technology-wise. All right, now let's go back to our charts. Here is Tesla. We'll look at weekly charts for all of these, and we can see that the bottom was able to be called from, again, multiple unrelated models here. I'll initially take the cloud off just so you can see. We had 9 counts. We came to a TDST line, which was the lowest low in a prior 9 count. We have propulsion exhaustion levels. So the bottom here, made in May, and a couple of weeks later, when we had the 9 count, gives us a reason to like this name. We look at it now moving higher. My guess is this should get to at least 972-ish or so, if not even 1,092. I'm not going to call for this to necessarily go to new all-time highs all the way up at 1,300 something. But when we look at how this has been trading, this is buying wholesale. Buying in here is what retail does. So if you were a buyer down here on these signals, was I waiting for confirmation? Nope. I stuck my neck out. I bought against support that I thought would hold. And notice that the support down here, this line, this dotted line that to me represents support, is not a place. Let me take that model off. I want to show you something. So this line is not a place your average technician would have, excuse me, picked as support. They would have said that down here, this line here is where support was. You would not have randomly picked where we found support to be a place the market would have bottomed. So not only do I know that there's support there before the market ever gets there, I know others are looking here. I'm not waiting to see if we got down there. I'm not waiting for the up move a few weeks ago, which you could buy. And look, if you got long at 800, you're at 923. It's a good trade. But if you got long at 800, where's your stop out? You're going to risk to new lows under 627? That's $175 on an $800 stock. You're risking more than even where the market is right now. So not necessarily the right way to be playing this. We stuck our necks out here and have a buy. Now let me go back to putting the sequential back up. All right, and now also I can put up my cloud chart, and I see that the weekly cloud also, even though price broke beneath the cloud, the lagging line, for those of you who know this, did not. So although you go into a very cautionary mode here, you're not in a sell signal. Now we come back up. We're on a 7 count up. We could extend past a 9, or we could have a big surge over the next few weeks. Either way, in probably a week to 2, I would take profits on this, and I'd be done. So if I'm potentially looking to get out of Tesla in the short term, then that also, as the biggest name in the ARKK fund, the biggest weighting, is going to affect my belief of how much ARKK is also likely going to go higher. So I need to take that into consideration when I play this. Next, let's take a look at Zoom. Zoom got badly beaten up, has a downside exhaustion signal close to the lows, and now it's actually at an important place because both the cloud's conversion line and baseline have come together, and we're trading exactly at those levels. Generally, that means very shortly we're going to have a decent directional move. If the bulls are right, we're going to move higher. If the bears are right, we're going to go retest the lows. So that's something I'm also need to pay attention to, both in playing this individually as well as how it bears on the ARKK fund itself as the second biggest weighted name, and not much behind the weighting in Tesla. Let's look at Roku. Roku is kind of similar looking to what Zoom is, although the two lines haven't come together. This is really still having trouble getting above the conversion line. The conversion line, this pink colored line, has basically been resistance since last October. And so it's having trouble moving up. And even if it moves up from 83 to 101, which in percentage terms is big, you can see how much more distance this would still have if this comes back into favor. So I will do some more work here to figure out which way I want to play this. But this is the third most important stock there. And now let's make our way through the rest as we're starting to get tight on time. Square, which is Block, right? They still use the ticker SQ, but they changed the company name to Block. Exhaustion signals near the lows, exhaustion signals on the high. That's selling wholesale and buying wholesale. And now we've broken above initial resistance. We're in between. Bigger up move targets 130 and change, but same type of thing. We'll see if this can hold above 76 on pullbacks. Unity, recent buy signal, right? Or better said, downside exhaustion signal. So we have multiple lows here. Don't know why my lines are shooting upward, but sorry about that. Here, let's just look at the support. Let me just remove this line. So look, 1, 2, 3, 4 different weeks, we got to the same level and we got a downside exhaustion signal right away, moves up. Institutions are buying because this is an institutionally used model and very few in the public have this and know how to use it properly. So now you'd be looking to potentially buying pullbacks and for the lows to hold for a move up to the baseline. So that's an idea and something that's, generally positive for the ARK fund. Teladoc hasn't quite reached exhaustion, although if I speed up the count, I'm guessing we will have. Yep. So it did father back in May, and it's basically gone somewhat higher, but still, when you realize how much these lost in percentage terms, this is a $300 stock that fell to what, $25 on the low, $27. I mean, it lost almost 90% of its value, or it did lose, right? 300. Yep, it lost 90% of its value. Incredible. So certainly, bigger up moves can go all the way back over 80, but these names, these beaten down, we'll call them Cathy Woods names, have a lot of work to do to get out of the woods. CRISP, CRSP. This is in the healthcare area. So exhaustion bottom, same thing, buying wholesale, selling wholesale up on the top and letting retail deal with all the stuff in between. Now we're up against resistance. You can see the bottom of the cloud is holding this. It needs to surge through this to have a chance then in coming months to get up to the top of the cloud at 110. Otherwise, this is going to pull back from here. So we've got to see how this, and I don't know when earnings come out, but earnings, if they haven't come out yet, are going to have a big play in how this moves next. Path, PATH. All right, so this is UPath. Same thing, downside exhaustion signal, doesn't have a lot of price history, but this is buying wholesale. And lastly, or actually there's 2 names left, Exact Sciences. So potential buy down here. This is all selling at institutions selling into this while others are still buying, and then the big move down, possibly kind of a near-term buy signal here, not quite as clear. So this one I'm more iffy on just because how it's acting and it has unfinished count to the bottom. And lastly, BEAM, BEAM. So look, selling wholesale, my 13 signals on the top, the whole move down, lows made, double bottom, we've moved up. There's actually resistance right here and right now. 9 count against the TDSD line. That was the highest high in this 9 count down. Again, came from a very non-obvious place. Most people would say maybe here's resistance, right? The high here at 80. You would not have picked this level to be resistance. And that's exactly where now we're stalling for a month. So that's the whole concept of buying wholesale or selling wholesale and selling retail, or in this case, buying, depending upon which way you're playing. But the idea is you want to fade the moves when you have the right signals to do so. And I don't wait 20% before I first get confirmation that something's happening. I stick my neck out and I do it. And of course, I'm doing this. I've had access to these models now for, let's say, time to marks models are the ones that count the numbers. That's 27 years I've been using these models, and generally known on the street as the most successful user of DeMark's models consistently over all these years. And that's why I have the institutional following I do, and the reason how and why institutions pay me some very substantial money to consult to them, to be able to help them trade around their core positions and when to enter and exit trades well before it's obvious to the average person. That's our show for this week. Again, follow us on YouTube. Go to In the Know Trader channel on YouTube to follow us. I'm Rick Bensignor, and this has been In the Know Trader.